Hello, this is Daniel Grady with a quick look at the markets for today, Tuesday, April 8th. We'll start with a look at the economic calendar. Coming up at 7:15 GMT, we have retail sales from Switzerland, which could have some impact on the Swiss franc. Then at 8:30 GMT, we have industrial and manufacturing production data from the United Kingdom, which could have some impact on the pound. We have an upcoming Bank of England meeting, which means investors could be putting a little more focus on this and we could get some more volatility out of this data. Then at 12:15, 12:30, we have housing starts and building permits from Canada, which could generate some volatility in the Canadian dollar. At 2 o'clock, we have a preliminary estimate of GDP for the United Kingdom, which could also generate some volatility in the pound. At the same time, we also have a private measure of job openings in the United States, which is an indicator of American economic health. So we could see some volatility here in dollar and in American stocks. And then in the evening at 8 o'clock, we have a rulemaking meeting for leverage ratios for the Fed. This is not expected to generate all that much volatility unless something really unexpected happens. Moving over to the markets, the S&P 500 continued to move on the downside yesterday. It broke below 1,850, which had been an important support level, and effectively erased all the gains of this index since the beginning of the year. However, 1,800 is a pretty strong support level. It's tried to get through twice, so we might see a correction here in the short term. The market might bounce off of this level. If not, it might continue further down. And during the Asian session, during early trading today, we had somewhat mixed results with the Japanese stocks moving on the downside, while we have Chinese stocks going up after yesterday's holiday. And then going into the session today, S&P 500 futures are trading up by 0.2% with a neutral sentiment bias in a survey of traders done by Market IQ. The euro is continuing higher after reaching the bottom here last week on Friday. In the intraday, it reached 137, which turned out to be good support. It pushed above our next level of resistance, which had been 137.40, which is now turned into support. We have a very weak level of resistance here at the Fibonacci retracement level at 137.60, which is just below that at the moment. If it were to break through that, we're reaching to a stronger resistance level at 138. And for the moment, support is at 137.40. The pound also continued to move higher. It broke above 166.10, and it's reaching towards 166.60 as the next level of resistance. And so 166.10 has now become our support level. Again, we have some important data coming out from the pound today, so we could see some strong volatility, with major risk being on the upside, with really good results coming out from data from the United Kingdom. We could see the pound pushing towards 168. The dollar versus the yen continues to gain strength against the dollar, which means the dollar-yen pair continues to move on the downside. During early trading today, it broke below 102.75, which had been our previous support level. That's now turned into resistance. Next support is at 102.30. However, there might be a intraday rebound here at 102.75, and if that's the case, it could return back to 103.40. However, that's not expected given the current market situation. And then finally, we have gold. Gold during the session yesterday, continued to move on the downside, despite RSI showing that it's still significantly oversold. So we have technical pressure on the upside, but we have market forces pushing on the downside. It's just below our interim resistance, and here at 1,310, it could push. We have support at 1,285, resistance 1,310 as the range at the moment. If it were to break above 1,310, which is the technical pressure at the moment, it could be looking at 1,340. However, that's not expected in the near term. And that's it for today. Thanks for watching and happy trading.